I'm going to show you two trading setups that I've used for over 30 years that you can use in any market or any time frame. Imagine only two trading setups that you can use in any market on any time frame. And those two trading setups I'll show you in the charts today. I'll show you how to use that system. The thing is, guys, it's not the system that's going to make you profitable. It's not the squiggly lines that's going to make you profitable, because at the end of the day, it's all about how you approach your trading, how you approach it with the right strategy. That's what will make you profitable at the end of the day. Because, as we all know, the market is a 50-50 game. And the reason for that, the market's made up of buyers, the market's made up of sellers. And would you believe every single one of those buyers and sellers believes they have the best system in the world, the best strategy in the world, and they're going to win in the market? Trouble is, everybody wants to win. Everybody wants to succeed. And everybody's got an opposing view. You can put two traders in the same room on the same system and they'll achieve a different result. In fact, they might even argue whether to go long, whether to go short on exactly the same trade at exactly the same time. Why is that, you might ask yourself? They're trading with the same system. They've got the same high probabilities. No, they have a different approach, they have a different mindset, and they have different strategies as to how they approach the market. But they're using the same system. Systems are not infallible. Every system on the market out there, every indicator on the market out there actually works. Every single one has been back tested by some clever guy. Every single one has the possibility or the probability of working. Because what is a trade on a chart? What it is, when you take a trade, when you take an investment or anything to that effect, what you're doing is looking at the high probability that you're going to make a profit in the future, whether it be on a 5-minute chart, whether it be on a 5-year chart, whether it be on a day chart. What you're looking for is that high probability that you're going to make a profit in the future. Not today, not now, not instantly, in the future sometime. Might be in the 5-minute future, it might be in the day future. Who knows? But that's what you want. That's why the market is a 50-50 game. Every single time you take a trade, you have no idea actually whether it's going to go in your favor, whether it's going against you. That's why we have a strategy to make you profitable. But I'll show you the systems on the chart now that will help you with that high probability trade. The two systems that you can use on any time frame. Guys, don't forget, trading is risky. 60 to 80% of traders do lose money. And if you don't like losing money and you don't like risk, probably shouldn't be trading. This probably isn't the place to be. Don't forget to pick up your free Forex book while you're here, guys. It's in the description. It's there for you. So without further ado, let me take you to the charts. Let me show you the system. And then after we've gone through the system that you can use on any time frame, you can use on any product, then we can talk about the strategy that you can use on a daily basis that will make you a profitable trader. Here's the charts, guys. There's two trading setups you can use to trade any market in any time frame. A lot of people don't realize how simple the system itself is. It's the strategy that's difficult for you. It's the strategy that you're struggling with. Now, these two systems are pretty simple. I'm going to remove all these drawings. Let's say you're looking at this. This is the US 500 and you're not sure where to start. So let's just take this out of the way and let's have a look at what we got. So this is on the 4-hour chart. Now, what I always do, you can do this on the 5-minute, you can do it on the 1 hour, you can do it on the 4 hour, you can do it on whatever you like. And you can trade Forex, you can trade commodities, like gold, for example, or you can trade indexes. I'm just using this index as an example. Okay, let's take that out the way so there's more space. Let's go. Now, what I normally do is if I'm trading on the 4 hour, I'm going to go to the day chart. Now, even if I'm on the hour, the 30 minutes, whatever the case, I'm always going to use the day chart because the day chart gives you the most reliable information. So there's my day chart. This is the US 500 over the last couple of months, and as you can see clearly that the day chart is bullish. This has been going long for quite a long period of time. Now what I do is I take it to a line chart, because the reason I want a line chart is because the line chart is simple closing prices. Whereas the candlestick chart is highs and lows, all these little tails, highs and lows. Why do I use candlesticks to trade? End of the day, I keep them red and green because I want to see the red candles. I want to know when it's going down out of my areas. I see the green candles. I want to know when it's going up out of my areas. The tails tell you the buyers are coming back in or the sellers are coming back in. And there's a whole bunch of other things that you can do with candles and patterns as well. You can download it off Google, and it's pretty straightforward and pretty simple. So we use the line chart to get the prices. Now there's two ways. And the first way is you want your support and resistance, your main support and resistance, so that you can see in the market kind of where the price is going to go to. It's like a magnet, and whether it's a resistance or a support, and you can know that that's a level where there's going to be money lying around. And the reason we draw it as a rectangle is so that you can get a better picture of where the money is. Because money doesn't lie in straight lines. It generally lies in an area. So you're looking for a general area. This is not an exact science, because the moment you stop seeing the market as squiggly lines and you start seeing the market as traders behind the squiggly lines, you'll understand that a little bit better, that there's a bunch of traders out there looking to buy here, and there's a bunch of traders looking to sell over here, and that's as simple as it gets. At the top here, we can see there's a level. We use that level and we draw resistance in. You can make this bigger if you want, just to give you a better insight as to what you're drawing in. So you see you're catching the bottom here, catching the bottom there. It likes to get down to here, go back up, get down to here, go back up. There's a one in there. You see 3 points, at least 3 points, and that one's nicely into the level. You can go further back all the way out to here. So if I draw this back out, you can see it was a resistance over here, broke through, and it became support. So this is quite a strong level. The 58.50, 58.88, strong level, you can use that. And at the top here, maybe this isn't as strong because it's at an all-time high, but I'll show you how we bypass that now. And that's your main resistance level. So what you're looking for is when it comes into the support, it's going to go up. When it goes into the resistance, it's going to come down. And you can use these levels all the way down here in structure as it's going up, because the market goes up, goes down, goes up, goes down, goes up, goes down, goes up, but it continues on in its trajectory all the way up, for example, if it's in a bullish mode. So that is your first trading setup, your resistance and your support. You're going to go back to the 4-hour and you're going to trade it there. But before we go back, let's draw our second trading setup in, and that is trend. We look at the trend, we draw a trend line in. Trend line should preferably go through 3 points. So there's your 3 points there. Okay. Now, you can look at this any way you want. A bit of experience tells me that's where it is. There's one. I would call that a second one, even though there's a bit of a gap there. 3, 4, and there's another where it's broken through 5, and there's 6. It's now resistance. Now, you've got your second setup. 2 setups that'll make you money in the market. Now, I'm just going to show you how to trade this, how to take the trade out of this. What you do now, you take it back to the candles. Now you're in a day. Now on the day chart, the way you look at this is that's your main resistance. Every time you get a red candle coming out of there, you sell. That's your main support. Every time you get a green candle out of there, you buy. You wanted to trade it on the day chart, you could do that. Same goes for the trend support. Every time you get a green candle going out of there, you buy. Every time it breaks through, that's a red candle, that becomes a sell. It's gone up, retested. You can wait for the retest if you want, but you don't have to. And then it's sell. So this is a sell. Now let's go back to the 4-hour and see what we've got on the 4-hour, because that's where we want to trade. We're trading on the 4-hour. You can do this on any time frame you want, but you want to have a look at how your main levels look on the time frame that you're trading on. We're trading on the 4-hour chart. Now, the number one thing to notice here, if you know patterns in the market, this is creating a kind of a head and shoulder pattern. It's breaking the shoulder. If it breaks the shoulder completely, then the head and shoulder pattern is null and void. You don't have to worry about it. But if it continues on down, then you do have to worry about it. But let's not worry about the head and shoulder too much. Let's have a look at, there's your main support on the day. There's your main resistance on the day. You can look for supply levels like this as well. In the 4-hour, but we're not going to go into detail. I'm only showing you 2 ways. Let's not show you 3 or 4 or 5, because you're going to get over confused. But if you do know supply and demand, you can look for these levels in the 4-hour chart that you're trading on, or the hour chart that you're trading on, or whatever the case. You can look for little patterns in your time frame. But what we have here is a scenario where it went all the way up, it's gone into resistance, and it's sat in resistance, and it's kind of consolidated. And instead of breaking to the upside, it's broken to the downside. But not only has it broken to the downside, it broke through the main trend support, making it a short trade. Then it's hit the main support level that you have, the first way to trade, and it's bounced out of there, gone back up, retested what is now a trend resistance, because it was a trend support, retested that level, and broken to the downside again, once again hitting the main support, bouncing out of the main support, creating a double bottom, which means it could go up from here. But now the big but here is, if it breaks through this main support level, goes down this 58 level here, then this is short. It's going all the way down. If it bounces up and it breaks through this level, see this level here, breaks through there, then it's going long again. So at the moment, you wouldn't want to actually take a trade here. Now the confluence is, there's a trend running through here right in this resistance. So once it gets above that level there and it breaks that trend, then you're looking at another long trade, and then it's going back up to the upside. But if it bounces off that and comes down, or even if it does it earlier, comes out of this level here and starts going down, breaks through this support level, then it's going short. Now, the reason we have candles, like I said, is if you get a big green candle like that, you know it's going long. You get a big red candle like that, you know it's going short. And it's just easier to spot. So now it's kind of sitting itself into this range. But it does seem bearish because it's broken through that support. It has retested. It has gone down. The only thing holding it up is this main support. And there's a good chance it's going to break through that and give you a nice correction, more than likely further down to the 55. Let me show you why on the day chart. If you go back to the day chart on this particular item and you say, but you know, it broke through there, so big deal, it could come down to here. Where's it going to go down to? If you look at your day chart a little bit closer and you pull it in a little bit, you will see that you can actually draw a level from the bottom along here, and you will see that that price level is going to hit somewhere down here at the 57. And if it breaks through that, and it's going to go very short, probably down to the 54, maybe even the 52. So you're looking at a 57 level here. You see where it crosses through here? You're looking at a 57 level here if it breaks to the downside. So you've got quite a lot of room. You can draw another line in if you want to, just to cover yourself off. So the two systems that I'm showing you is effectively straight line support and resistance on price action and trend line support and resistance on price action. And those are the only two systems that you need to trade. You don't need anything else. You can use all the others, the supply and demand, the Fibonacci's and all that. But if you just use these two systems, you'll be successful on any time frame. You'll be successful on any product, and you won't have to stress about it at all. Just putting it back on the 4 hour. And on the 4 hour, you can clearly see the line charts there as well. I didn't mean to move the line chart. It's just the way I grabbed the chart. And there you go. Candles back in. The candles, like I say, the candles just give you a clear idea. You see what you're looking for. If you see a big red candle like that, that's a whole bunch of sellers that got in there. And then if you see the tails, that's the buyers getting back in, for example. And then on the green candles as well, you know, if you get a huge green candle going up and then you get that tail, that's all the sellers getting back in. So that's how you look at the candles. You can look at all the shapes and sizes and all the rest of it, and hammer candles and dojis and all the rest of it. But a candle only lasts for its next candle on time frame. So if you're trading on the 5-minute chart, a candle only tells you what's going to happen for the next 5 minutes, not for the next 5 days. So those are your two systems, guys, and that's what you can use. Now go and have a look at the strategy and how you can actually make money in the markets, because this is only how to trade. That's just sort of a high probability trade. Doesn't mean you're going to win. That's 50-50. Go and check the strategy. That'll make sure you win every trade. Now you've had a look at the charts. And now you know exactly what the probability trade is. Now you know the two systems that you can use anywhere. There are many, many other systems available out there to you. There are guys that'll teach you that you can have a Lamborghini next week, but it doesn't work like that, because trading is a long game. It takes a while to get your head around it. It takes a while to get used to it, and it takes a while to become a good trader. You can't learn this in a week, guys. The guys that are teaching you that you can learn how to be a great trader in 1 week, 1 day, or you'll be driving a Lambo next week or something like that, they're effectively lying to you. It's not going to happen. It's never going to work. You have to learn how to do this properly. That doesn't mean going on a course. How much did you pay for your course? You went on a course. You did so well on the course. You came back and you know all the abbreviations, you know all the terminologies, and now you think you're a professional trader. You've done a few demos on the course. You've worked with a few other people. And then suddenly you go and put real money in the market and everything changes and it's not the same anymore. Suddenly you start losing. Suddenly things start turning against you for whatever unknown phenomenal reason. And that's the thing. with trading. It's all about the psychology, and it's all about how you handle the psychology. You've got to get your mind around the fear in your brain, the fear that we're all born with. And the fear of losing money is actually quite a big one. So how do we get around this? How do we approach things so that we can become profitable in the market? We can't rely on a system. One thing for sure, we cannot rely on a system. A system will just give you a win rate. And as you know, those of you who know me, and for those of you who don't know me, I'm Rob. I didn't introduce myself, but for those of you who know me, you'll know that I don't believe in a win rate. Because a win rate, you can win 9 trades out of 10, but how much did you win on those 9 trades? For example, if you won $10 on 9 trades and you lost $1,000 on the 10th trade, you ain't doing so well. That's what I always tell you. Win rates are worthless. What you need is profitability. Now, to get profitability in any business, you need some form of business plan. You need some form of idea that you're going to make a profit with. So, for example, if you're selling eggs, you want to buy them for 5 Rand and you want to sell them for 10 Rand and you want to make a profit. It's as simple as that. That's your plan. Your plan is to buy them for 5 and sell them for 10. Okay, so how do we do it with stocks? What you do is you have an account with a size in it. So let's say the account size is $100,000. And as I've always said to you guys, I don't mind whether your account's $5,000 or $50 million. I'm just using this as an example. Then you trade 1% of that account on every single trade. You don't change it. You keep it the same. You keep the risk the same forever, or until you change the size of the account. The size of the account doesn't change on every trade, whether it goes up or down. You're trading that size of account. If it's a $100,000 account, it remains that. If it goes down to $90,000, you still trade $1,000 on every trade. If it goes up to $150,000, you still trade $1,000 on every single trade. You keep that the same. You keep it as the initial account size until you decide that the account size is now something else. Then you can change your 1% to that. The basis of it is keep your account trades the same size. Now, how do you work this out? Because you'll say, yeah, but if I put a stop loss there, it's going to be too tight and all the rest. No, that's not how you work it out. What you do is you see a trade that you would like to trade. You say, that's the trade. I'd like that trade. That trade looks good. Then what you do is you say, well, my stop loss is going to be $1,000 because I've got a $100,000 account, and that's a 1% of the $100,000. Then what I do is I go to the trade and I have a look at where my invalidation point might be. And I go and have a look at where I want to put the stop loss, which is the invalidation point. The reason I say invalidation is because when you want to put a stop loss in, you're looking for a place that if you looked at the trade and your price was at that point, then you would say, I ain't trading this no more. This is rubbish. I don't want to touch this. Or if you walked in today and said, I wouldn't touch that with your money. I'm not trading that. Okay, that's an invalidation point. Now you look at that and say, well, that's where I want my stop loss to be. Because if the price gets to there, my trade is useless, my trade is worthless. Then what you do is you say, all right, how much is $1,000 from there to where the cost is now? How many contracts, how many points, how many shares, whatever it might be. How much can I buy to make up that $1,000? Then what you do is that's the size of your trade. But now your profit target cannot be $50 or $100 or $300 or whatever the case, because you're risking $1,000. So it's got to be more than $1,000 and preferably 2 to 1. So you preferably want to be making $2,000. But that doesn't mean you just place your target at $2,000 and hope for the best. It's got to be a reasonable target. It's got to be a good risk to reward, because if you are looking for a $2,000 profit and the risk to reward is not there, then there's no point in the trade. If you're putting it at $2,000 and saying it'll definitely reach that, then it's a good trade. But if you're putting it there and there's just no chance it's going to reach that target, then there's no point in that trade. It's not going to work. The risk to reward is not there. Walk away. If you can only see a $500 profit on a $1,000 risk trade, don't take the trade. Trade's worthless. It's not going to work. So make sure that the reward is viable, that you can actually reach that reward when you take the trade. It's the only way to do it. So now you take the trade with a possible $2,000 profit. Now you're in the trade. Great. And it goes into a loss. Rule 1, do not dollar cost average. Rule 2, don't move the stop loss away if it's going down to the stop loss. If it hits your stop loss, take it, walk away, because remember when you took the trade, you said it would be invalid if it got to that price. Do you remember that? That's important. So when it gets to that price, don't go changing your mind. Don't go moving it around. Don't go moving it away, and don't go dollar cost averaging it because you want to stay in the trade. Walk away. Look for a new trade. You're going to lose 5 out of 10 and you're going to win 5 out of 10. The point here is you want to make more than the 5 wins. Now, let's say it goes into a profit and it goes $300-400 into profit. Now I know you're sitting with your finger on the sell button, you all are, but you don't want to do that. Break your fingers or something, stop them from doing it, because you're going to click sell if you're sitting watching that chart. I prefer not to sit and watch the charts if I can help it. I'd rather take the trade, walk away, come back and have a look later. But some of you like to sit and watch charts all day. And when it goes $300 or $400 into profit, you're going to be sitting with that itchy finger trying to sell it. I'm using the finger because it's a mouse, right? What I'm saying to you here, guys, is don't click sell. But you sit on your hands, as they say. Just sit on your hands and just wait. The price will go up and it'll keep on going up, let's say. If it comes back, so be it. That's just bad trade. But a good trade should keep on going up. If it gets to $500, $600, $700 in profit, take your stop loss from $1,000, which you would have lost, and now put it up to break even or even $100 in profit, because then you're not losing anything. And also you're in profit, right? Makes sense. Now, a lot of people will say, yeah, but when that comes back from $700 and it takes out the break even or the $100 profit, then I've lost all that. You haven't lost anything. It's funny though, because when you're in a loss, you'll dollar cost average, you'll add to the trade, you'll lose thousands and you won't consider that a loss. You'll be sitting deep in a drawdown and you won't be considering that a loss. But when you're in a profit, you won't average up and you won't hold the profits and say, well, you know, I'm in a profit. So you'll have a whole mishmash of little profits that have been taken out by that trailing stop, and you'll have a whole mishmash of little losses where you got out early. That's how trading goes. It's not going to be much different to the trading you're doing now if you do that. But at least now you have an opportunity to make a bigger profit. So let's say it goes up and over $1,000. You move the stop loss right up to maybe $700 in profit. Now you've got a decent profit. Let's say it goes up and it starts hitting your target at $2,000. Move the stop loss right up behind it. Comes back and takes it out. You pretty much made target. And if it carries on going, you make a bonus trade. You get that? All that money that wasn't yours behind that, you can actually follow it. You can actually make some profit. Now, I got nothing against someone taking their profit at target level. You can do that. There is nothing wrong with doing that. Fully for you, you've made a profit because that's a good profit. All I'm saying to you is, don't risk $1,000 and take $300 profit. If you're going to risk 1,000, try and make 1,000 at least, or 1,500. Because at the end of the day, the market is 50-50. And if you lose 5 and win 5, and you only lose 1,000 and you win 1,000, then you break even. Look, even to be a break-even trader is quite a potent thing, quite a good thing in the markets, because there's not many of those. But at least try and make a little bit. Try and make a profit on it. So even if you make 1.5, at least it's more than what you're losing, and you're taking a profit over every 10 trades. That's what you're looking for. It's not to say that you can't lose 10 in a row, not to say you can't win 10 in a row. But let's say you do lose 10 in a row. That's $1,000 per trade on a $100,000 account. You've lost 10% of your account. You haven't lost your whole account, and it's recoverable. I mean, most people will have a 10% stop loss on a normal shareholding. It's normal. So for you to have a 10% loss on in the entire game, you're okay. You're doing okay. Don't be greedy. Do be patient. And the market will lull you into a false sense of security if you're not careful. But hopefully those two systems that I showed you, those high probability systems, will help you along the lines with the strategy, and you can become a profitable trader in the markets. Guys, don't forget to come back for the live show tomorrow. Tomorrow it's the US session. Come back and enjoy it with me. Let's have a little bit of fun, and watch the last videos so that you can get a little bit more insight into my strategy on how to be profitable in the market. Guys, thanks for watching. Till the next time, ciao, thanks, and bye.